In 2008, American households lost $13 trillion in under 18 months. Not stolen, not burned, not confiscated by a government, just gone. But here is the fact that should permanently rewire how you think about every market crash you will ever live through, that $13 trillion did not stop existing. Money never stops existing. It moved. And today I am going to show you the exact map of where it went, who received it, and what they did with it next. Because the people who walked out of 2008 richer than they walked in were not smarter than you. They just understood something that nobody bothered to explain on the news, and by the end of this video, you will too. Let's establish something before we go anywhere. The most destructive idea in personal finance, the one that causes regular people to make catastrophically wrong decisions during every single crash, is this: when markets fall, wealth disappears. That idea is wrong, not slightly wrong, structurally, fundamentally, dangerously wrong. And the fact that it feels true is exactly what makes it so expensive. When you check your brokerage account and your portfolio has dropped from $40,000 to $24,000, your brain registers a loss of $16,000. But here's the precise distinction that changes everything. You did not lose $16,000. You lost a paper agreement that said your shares were worth $16,000 more than they are now. The shares still exist. The company still operates. The agreement on their value simply shifted. This is not a technicality. This is the entire ballgame. Markets do not measure how much actual cash exists in the economy. They measure what people collectively believe assets are worth at any given second. And collective belief is not a fixed quantity. It swings on sentiment, headlines, fear, and greed, sometimes completely disconnected from the underlying reality of what a business earns or owns. When that collective belief collapses rapidly, we call it a crash. When it collapses more than 20%, we call it a bear market. Neither event destroys money. Both events relocate it, and in some cases, simply reduce the agreed-upon number on a screen while leaving the actual underlying asset completely intact. Understanding that distinction is what separates the people who panic from the people who profit. Let's now follow the money. There are 5 places your money goes during a crash. Every dollar that appears to vanish is actually traveling toward one of these 5 locations. Some of them you can position yourself to receive. Others you need to understand simply to avoid feeding them involuntarily. Destination 1: cash and money market accounts. The first and most immediate recipient during a crash is cash itself. When fear accelerates and investors begin liquidating positions, the instinct is simple: get out, preserve capital, convert everything to cash before it loses more value. This is called the flight to safety, and during serious downturns, it creates a wave of liquidity flooding out of equities and into the most basic form of financial safety: actual dollars. Here is exactly what that looked like in real time. When COVID hit in February 2020 and the S&P 500 began its 34% collapse over 33 days, the fastest bear market decline in recorded history, money market funds absorbed $1.1 trillion in net inflows within weeks, not months, weeks. Retail investors, institutional funds, endowments, family offices, all of them converting holdings into cash simultaneously. The scale of that movement is why the equity sell-off was so severe so fast. Supply of sellers overwhelmed buyers by a staggering margin. Now, the important nuance: cash does not earn the transferred money from people selling stocks. It absorbs the liquidity that leaves the equity market. The real exchange is happening between the sellers and whoever is still buying on the other side, and we'll get to those buyers in a moment. The problem with the flight to cash: most people execute it at exactly the wrong time. They hold through the early stages of a decline hoping for recovery, capitulate near the bottom when fear peaks, and then stay in cash too long, watching the recovery happen without them. They convert a paper loss into a permanent one and then miss the rebound. The people doing this are not unintelligent. They are human, which is why this pattern has repeated identically through every market crash since 1929. And will repeat again in the next one. Destination 2: bonds and government securities. This is the most powerful structural counterweight to equity crashes, and most retail investors interact with it only by accident or not at all. Here are the mechanics in plain terms. Government bonds, particularly U.S. Treasuries, are instruments where you lend money to the government for a fixed period in exchange for guaranteed interest payments. During a crash, when investors are fleeing risk at any cost, demand for that guarantee surges. That surge in demand drives bond prices up and yields down. The result is historically remarkable. In 2008, as the S&P 500 lost 37% in a single calendar year, long-term U.S. Treasury bonds returned approximately positive 30%. Read that again slowly. While equity markets were cutting portfolios in half, investors who held long-term government bonds were generating substantial positive returns in the same window. This is not coincidence or luck. It is the structural reality of how bonds behave in a risk-off environment. It has happened in every major crash with near-perfect consistency. In Q1 2020, as equities collapsed in February and March, the 20-plus-year Treasury bond ETF returned approximately 20% during that exact window of equity freefall. This countercyclical behavior is the reason every professional portfolio construction framework includes bonds, not because bonds generate exciting long-term returns, but because they catch the liquidity that exists in equities during crises and actually appreciate when equities collapse. If your portfolio has zero fixed income exposure, you are structurally unprotected in the most dangerous moments in the market. Destination 3. Short sellers. This is where the most direct and dramatic transfer of wealth occurs, and it is the destination most people never think about at all. A short seller is an investor whose financial outcome is inverted relative to yours. When the market falls, they make money. When it rises, they lose it. The mechanics work like this. A short seller borrows shares of a company at $90 per share and immediately sells them in the open market, collecting $90 per share in cash. The plan: wait for the price to decline, then repurchase those same shares at the lower price and return them to the lender. The difference between the sale price and the repurchase price is pure profit. Borrow at $90, return at $55. Profit $35 per share. This is not gambling with a house edge. This is a legitimate institutional strategy that requires deep research into financial fragility, over-leveraged balance sheets, and misrepresented valuations. The best short sellers in history spent months or years building their thesis before a single dollar moved. The most documented example in modern financial history is Michael Burry. Before 2008, Burry's fund, Scion Capital, recognized that the U.S. housing market was built on fraudulent mortgage underwriting and that the securities backing that debt were catastrophically mispriced. He bought credit default swaps, essentially insurance policies, against mortgage-backed bonds at pennies on the dollar when the rest of Wall Street considered the housing market untouchable. When the housing market collapsed, Scion Capital generated approximately $700 million in profits for investors from those short positions. His personal take from that trade was around $100 million. While retirement accounts across America were being gutted, Burry's precise positioning meant that every dollar those mortgage bonds lost transferred, in large part, directly to him. Short sellers are not villains in this story. They are the investors willing to bet against consensus when consensus is wrong, and they get paid in exact proportion to how right they were. Destination 4. Physical and real assets. Gold, physical property, commodities. These are the assets that behave differently from paper markets precisely because their value is not entirely dependent on collective financial sentiment. Gold is misunderstood because of an important but rarely explained short-term behavior. During the initial shock of a crash, gold often declines alongside equities. The reason: investors facing margin calls and liquidity crunches sell everything liquid to raise cash, and gold is highly liquid. In October 2008, at the peak of the financial crisis, gold dropped roughly 15% alongside equities. But the medium and long-term story is different. By early 2009, gold had fully recovered from that decline. By 2011, With the full weight of the post-crash quantitative easing programs visible to the market, gold had climbed from approximately $800 per ounce in early 2009 to above $1,900 per ounce, a 137% gain in roughly 2.5 years, beginning from a crash-era entry point. The pattern: gold does not typically catch the first wave down, but it absorbs the monetary expansion that follows every crash response, and it rewards the investors who position themselves during the panic with substantial long-term gains. Real estate is more crash-specific. In 2008, because the crash was triggered by a real estate bubble, property values fell significantly and housing was the problem, not a refuge. But in other market crashes unrelated to real estate, the dot-com bust of 2000 to 2002, for instance, physical property held value relatively well compared to equities. The consistent thread: tangible assets with real utility are not priced purely by sentiment. Their prices can fall during crashes, but they fall less violently and recover more predictably because their intrinsic value of land that exists, gold that cannot be printed, does not depend on market confidence. Destination 5. Strong hands, the most important one. This is the fifth destination, and by an enormous margin. It is the most consequential for anyone who wants to understand not just where money goes in a crash, but how to be on the receiving end of it. Strong hands is the term for investors, individual or institutional, who held cash or highly liquid assets before the crash and deployed that capital aggressively during the collapse to buy quality assets at severely discounted prices. This is how generational wealth concentrates during downturns, not through theft, not through manipulation, but through the simple mechanics of having cash available when everyone else is desperate to sell. Warren Buffett's September 2008 Goldman Sachs investment is the cleanest illustration that exists. At the height of the financial crisis, Goldman Sachs was desperate for capital. Banks were failing. Confidence in the entire sector had collapsed. Goldman needed money fast, and they needed a signal to the market that a sophisticated investor still believed in their viability. Buffett had been holding significant cash reserves at Berkshire Hathaway while the market ran euphoric in 2006 and 2007, a period when most investors were fully deployed and chasing returns. He had been called overly cautious. His cash pile had been characterized by financial media as a sign that he had lost his edge. Then the crash came. In September 2008, Buffett invested $5 billion directly into Goldman Sachs on his terms. He received preferred shares, paying a 10% annual dividend, plus warrants to purchase additional Goldman shares at a fixed price below market value. Goldman was desperate. Buffett had cash. He named the deal. By the time markets recovered, Berkshire's Goldman investment generated over $3.7 billion in total profit. In the same window, he deployed $3 billion into General Electric on nearly identical terms. These were not fortune-telling maneuvers. They were the payoff of years of disciplined capital preservation, while everyone else was fully invested and euphoric. The crash did not make Buffett rich. The crash was the moment that all his preparation became profitable, and this pattern is not exclusive to Buffett or to professional investors. During the COVID crash of 2020, the S&P 500 bottomed at a closing low of 2,237 on March the 23rd. By November 2021, 20 months later, the index was trading above 4,700. Any retail investor who deployed available cash into broad index funds near that bottom effectively doubled their money in under 2 years. $20,000 deployed at the bottom became over $42,000 before the market had even been in recovery for 2 years. The crash did not destroy those investors. The crash generated their returns. The paper losses of the panicked sellers transferred directly into the portfolios of the buyers who understood what they were looking at. Let's put precise numbers on the 2008 crash, because this is where most finance content glosses over the details and leaves you with nothing actionable. Between October 2007, the market's peak, and March 2009, the market's bottom, the S&P 500 fell from 1,565 to 676. That is a 56.8% decline. U.S. household net worth dropped from approximately $67 trillion to $54 trillion, a contraction of $13 trillion. Now, of that $13 trillion, Approximately $8 trillion was pure paper wealth. The collective agreement on asset valuations repriced downward with no actual cash changing hands, no dollar physically moved anywhere. The number on the screen changed because market confidence changed. That is all. The remaining $5 trillion represented actual cash flows, real money that moved through selling, margin calls, foreclosures, and liquidations into the destinations we just covered. And the $8 trillion in paper losses? It came back. Because paper losses do not represent the destruction of underlying value, they represent a temporary collapse in confidence. The S&P 500 crossed back through its October 2007 peak in March 2013, less than 4 years after the absolute bottom. Here is the return calculation that proves why staying invested through a crash matters more than almost any other single financial decision you will ever make. $10,000 invested at the peak of the 2007 bubble, the absolute worst entry point possible, would have grown to approximately $32,000 by early 2024, including dividends reinvested. That is a 220% total return, achieved by someone who bought at the single worst moment in a generation and held through a 57% collapse. The crash looked like the end. It was the middle. Reason 1, they convert paper losses into real ones. When you sell during a crash, you do not protect yourself from the loss. You lock it in permanently and hand it to whoever buys your shares at the discount. The Dalbar quantitative analysis of investor behavior tracked this across a 30-year period from 1993 to 2022. The S&P 500 returned an annualized average of 9.65% per year. The average equity fund investor over the same period earned just 6.81% per year. That 2.84% gap is almost entirely behavioral buying near highs when sentiment is good and selling near lows when sentiment is bad. Run that gap over 30 years on $100,000. At 9.65%, $100,000 grows to approximately $1,576,000. At 6.81%, $100,000 grows to approximately $720,000. The difference of $856,000 was not taken by the market. It was surrendered to it by emotional decision-making during exactly the moments of volatility that feel the most convincing. Reason 2, they have no capital to deploy. Being fully invested with zero liquidity reserve is not discipline. It is leaving yourself unarmed when the sale arrives. Crashes are the single greatest buying opportunity that a long-term investor will ever encounter, but buying requires capital. If your entire investable net worth is already deployed with nothing held back, you watch the discount materialize and cannot touch it. This is why the investors who consistently outperform over full market cycles are not the most aggressive in bull markets. They are the ones who preserved some portion of capital specifically so they could be the buyer when everyone else is the seller. Reason 3, they treat a temporary event as a permanent new reality. Every single bear market in U.S. financial history has recovered and exceeded its previous peak. Everyone, without exception, from the Great Depression, through Black Monday, through the dot-com bust, through 2008, through COVID. The average bear market since 1928 has lasted approximately 9.6 months. The average subsequent bull market has lasted approximately 2.7 years. The math of staying invested is not complicated. The psychology of staying invested during the 9.6 months is genuinely hard. Nobody prepares you for that part, and that unpreparedness is what makes the behavioral gap real. Step 1, maintain a permanent liquidity reserve. This is capital held separately from your emergency fund and separately from your long-term investment portfolio. Its only purpose is deployment during market dislocations. A reasonable framework used by institutional investors, 10 to 15% of total investable assets held in cash or short-term treasuries at all times, not because a crash is imminent, because when it arrives, you need to be able to move within days, not months. Step 2, own things you understand deeply enough to hold through a 50% decline. A broad index fund tracking the total stock market has recovered from every crash in recorded history because it represents the diversified output of the entire functioning economy, not a single company, not a single sector, not a single bet. If you own individual stocks or sectors, you cannot fully explain if you do not understand the revenue model, the competitive position, and the reason the company will still be operating in a decade. A crash will terrify you into selling because you have no rational framework for why the price should return. Own what you can explain. Understanding is what gives you the psychological stability to hold when nothing else does. Step 3, automate the mechanism so your emotions cannot override it. Dollar cost averaging is the single most powerful tactical tool for surviving a crash and actually profiting from it. Here is exactly why. If you invest $600 every month into an index fund and the market drops 40%, your $600 now purchases 67% more shares than it did before the decline. Every month, the market remains depressed. You are accumulating shares at a discount. When the recovery arrives, and the historical record says it always does, you do not just return to your previous balance. You return to a higher balance because you own significantly more shares than you would have owned if the crash had never occurred. The crash is not the enemy of that strategy. The crash is the mechanism that makes it work. Profit plot exists for one reason: to show you the systems that determine financial outcomes, explained precisely and practically so you can make better decisions with real money. Subscribe, you will not regret it. In 2008, $13 trillion disappeared from American household net worth. We now know exactly what happened. $8 trillion was paper wealth, a collective repricing of asset values that reversed completely within 4 years because the underlying assets never changed. The agreement about what they were worth changed. Then the agreement changed back. The remaining $5 trillion transferred to bond markets, absorbing the flight to safety, to short sellers who had precisely positioned themselves against the collapse, to institutions with cash reserves who deployed capital into quality assets at catastrophic discounts, to anyone who stayed invested through the paper loss and held to the recovery. The crash did not create random winners and random losers. It sorted investors by preparation. The people who lost permanently sold paper losses into real ones, held no liquidity, and confused a 9-month event with a new permanent reality. The people who won held quality assets through the volatility, deployed available cash at the bottom, and understood that every dollar of discount they were buying was exactly equal to the dollar of fear that the seller on the other side was paying to exit. That is not luck. That is not superior intelligence. That is understanding the map. Now you have it. Here's your challenge. Take the next 5 minutes of your time right now and answer one question honestly. If the market dropped 40% this week, would you have capital available to deploy into it? If the answer is no, you just identified exactly where your strategy has a gap. Fix that gap before the next crash fixes it for you. Drop your answer in the comments. I read every single one. See you at the next one.